Bitcoin is no longer just for tech geeks. It's on the stock market now.
In 2024, history was made when US regulators finally approved the first spot Bitcoin ETFs. This means you can buy Bitcoin like buying an ETF in your regular brokerage account. In this video, we unpack why the arrival of Bitcoin ETFs is such a big deal, what it means for investors, both crypto enthusiasts and skeptics, and how it might impact the crypto market and your portfolio. For years, the crypto community eagerly awaited a spot Bitcoin ETF, an ETF that actually holds Bitcoin. And in January 2024, the SEC gave the green light. Suddenly, Wall Street's doors opened to Bitcoin in a whole new way. Firms like BlackRock, Fidelity, and others launched Bitcoin ETFs that hold actual BTC in custody on investors' behalf. The immediate impact was huge. By the end of 2024, Bitcoin's price more than doubled, even hitting the milestone of $100,000. Part of that surge was attributed to the flood of new money entering through these ETFs. Think about it. Many investors, like retirees or institutions, who couldn't or wouldn't use crypto exchanges, could now simply buy an ETF in their 401k or brokerage. Tens of billions of dollars flowed in as Bitcoin became as easy to buy as a share of Apple. What exactly is a Bitcoin ETF? It's basically a traditional exchange-traded fund that holds Bitcoin as the underlying asset, usually via a custodian. When you buy a share of the ETF, you effectively own a slice of that Bitcoin pool. The ETF's price tracks the price of Bitcoin, minus small fees. This is different from earlier Bitcoin futures ETFs, which have existed since 2021. Those held futures contracts and could diverge a bit from spot price. A spot ETF is straightforward. One share yields some fraction of one Bitcoin in value. For investors, it means no need to manage wallets, private keys, or worry about crypto exchanges getting hacked. It's Bitcoin investing with the convenience and regulatory oversight of the stock market. The first wave of these ETFs in the US saw major players involved. For instance, BlackRock's iShares Bitcoin Trust, IBIT, launched with huge anticipation. There were also products from Fidelity, WisdomTree, and more. Some had promotional low fees initially. BlackRock's ETF in particular attracted massive inflows. Within months, it reportedly gathered over $10 billion in assets, contributing to Bitcoin's rally. By the end of 2024, analysts noted that the new Bitcoin ETFs were among the best-performing ETFs on the market, thanks to Bitcoin's price jump. It was a validation moment for crypto, being embraced by the very financial institutions that once shunned it. So why is this a game changer? Accessibility and legitimacy. Accessibility. Now any investor can put Bitcoin in their portfolio as easily as buying any stock or bond fund. This opens the doors for retirement accounts, institutional allocations, and even financial advisors to include Bitcoin for clients. Legitimacy. Regulatory approval of these ETFs signaled that Bitcoin is mainstream enough to be allowed in the traditional system. It reduced the stigma and perceived risk for some. We even saw more companies put Bitcoin on their balance sheets or reference it as an investable asset, as it's considered less of a regulatory gray area. However, investors should understand that a Bitcoin ETF doesn't magically make Bitcoin a risk-free asset. It's still volatile. In 2024, it went up a lot, but it can go down a lot too. The ETF structure just makes it easier to hold and maybe reduces some logistical risks, like losing your keys. There are also management fees, maybe around 0.5% or less in some cases. Not huge, but something to note versus holding Bitcoin directly. Also, ETF trading hours are market hours, whereas Bitcoin trades 24/7. If big news hits on a weekend, Bitcoin price might move, but you can't trade the ETF until Monday. Most ETFs addressed this with some flexibility or futures for off-hours pricing, but minor deviations could occur short-term. Another consideration: multiple Bitcoin ETFs exist, and they all hold the same thing: Bitcoin. How do you choose? Some differences could be an expense ratio, the trustworthiness of custodian, or any perks like insurance. But generally, a low-fee, high-volume one like BlackRock's or Fidelity's might be preferable due to liquidity and lower tracking error. Over time, competition may drive fees down further. Impact on the crypto market has been significant. Aside from price, having ETFs likely stabilizes the market somewhat by bringing in long-term and institutional holders. It may also reduce the premium on other vehicles like the Grayscale Bitcoin Trust, GBTC, which for years was one of the only options but traded at discounts premiums due to its closed-end nature. With ETFs, such arbitrage opportunities shrink as pricing becomes more efficient. Additionally, altcoins and other crypto projects might gain indirect exposure. For example, now that Bitcoin ETFs are okay, people speculate if Ethereum might be next for a spot ETF approval. For intermediate investors and even retirees, the question becomes, should you invest in a Bitcoin ETF? If you've been curious about crypto but hesitant to deal with it on crypto platforms, the ETF is a convenient entry. It can be a small diversifier. Some treat it like digital gold, a hedge, or a growth asset. Financial advisors often suggest only a small allocation, 1–5% of a portfolio, because of volatility. But even that small slice, as we saw, can have a notable impact when Bitcoin surges or dips.
Retirees specifically should consider their risk tolerance. Bitcoin can swing wildly in short periods.
Yet, interestingly, now that interest is broadening, we see even some retirees dabbling, especially those who believe in the long-term story of blockchain or want an inflation hedge. One should also keep an eye on regulatory developments. The approval came after much lobbying, and it's unlikely to be reversed. But crypto regulations can evolve, for example taxation, or if any security concerns arise. Still, having big-name custodians and auditors involved in ETFs likely increases safety versus some offshore exchanges. In summary, the advent of spot Bitcoin ETFs in the US marks a new era. It took Bitcoin from the Wild West of finance and parked it right on Main Street. The result? A wave of new investment, a surge in Bitcoin's adoption and price, and a new tool in investors' toolkits. Whether you're pro-crypto or still skeptical, it's an important development to understand. It bridges the old and new financial worlds. As we move forward, we might see more crypto asset ETFs. But Bitcoin is the big one that opened the gate. Now, investors can decide, do you want some Bitcoin exposure in your portfolio? If so, doing it is as simple as a ticker symbol now. Truly a game changer for the investing landscape.